Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, and amazing people all around the world of crypto and blockchain globally. And today I have another amazing guest. He is coming to us right now from France. He is Laurent Benayou. He is the CEO of Acheron Trading. Laurent, welcome to the show.
Hey, Jamil, thank you very much for having me on.
You're very welcome. Thanks for joining me today. Let's kick things off, and I have the first question for you. What is your background, and is it a logical background for what you're doing now?
Yeah, absolutely. So my background is in, I guess, academic background is in pure math, and then I did some applied math as well, financial math. So I guess it is relevant to a certain degree to what I'm doing now. As you said, I'm the CEO of Acheron Trading. So Acheron is a market maker for digital assets. Essentially, we provide liquidity and we build efficient markets for the benefit of all market participants. And the goal really of that is to increase the adoption of crypto because we see it as the future of finance. So yeah.
Awesome, awesome. So your vision and your mission for Acheron Trading is what exactly?
It's what I mentioned, essentially building, efficient and healthy markets for all market participants. So those market participants are issuers, they're investors, their community, and the vision is again to, participate in the adoption of crypto as the future of finance. Yeah.
I like the concept of efficient and healthy for everybody. We don't have that today, right? Um,
Yeah.
So how would you describe on a global landscape, what's efficient, what works efficiently, and what's inefficient, and what has room to be improved?
Right. Um, a number of things. First of all, an efficient market means a liquid enough market. And a liquid enough market is one where someone can enter and exit positions when they want and in the quantities that they want without incurring crazy, what we call slippage. So essentially the difference between the price they may see and the execution price that they will receive at the end, right? So that's an efficient market. Now, you're right, a number of markets out there are not efficient, and we're trying to plug our systems where we are asked to do so. And the goal is essentially to narrow, what we call the bid-ask spread, to essentially, bring buyers and sellers closer together to increase market depth. So essentially to provide that kind of like depth of the order book so that people can, transact in the quantities that they desire. But yeah, there are a number of things that are inefficient. We've seen the rise of multiple chains. And so typically bridging across chains is one thing that requires potentially, some time. So you may have some downtime on such markets. There are markets where we're not contracted to work, so we may not have the incentives to work on those markets. And then there are other issues, potential issues that arise with regulation, for example. I guess we can talk about that in a moment, but um, I'm thinking in particular, when the regulator is approaching a regulatory question, they're going to think about the well-known actors and the well-known players in the industry. So they're going to think about investors and investor protection. They're going to think of exchanges to prevent some of the stories that we've heard in the past. But they're not necessarily going to think about more confidential market participants like market makers, right? And so they're going to establish rules that are going to apply to those big players and those big groups, but they're not necessarily going to cater to market makers. And in particular, there's a rule in Europe, for example, related to sub-custody. It's very specific, but this rule essentially prevents market coverage to a certain degree, right? When you have an asset, you have an issuer coming to you as a market maker. Um, Typically the path to secondary markets is a token generation event, a listing on a decentralized exchange, and then follow-on listings on, smaller exchanges or, that are not considered top-tier exchanges, and eventually the asset matures to be listed potentially on those top-tier exchanges. Obviously, the top tier exchanges are going to target Europe as a jurisdiction of choice because of the audience there. But you cannot expect an asset, you cannot reasonably expect an asset to list from day one on top tier exchanges. It happens very rarely, right? And so essentially, by saying that, market makers can only trade on regulated exchanges, which makes reasonable sense, right? But by saying this, they're leaving a gap in liquidity coverage between the decentralized exchange stage and the top tier exchange stage for a project. And that's, a concern that we voiced, for example, with the regulator in Europe. So, if inefficiencies arise due to a variety of reasons, is what I'm trying to exemplify.
Yeah, I'm in the US. I buy my crypto on Coinbase. Right now I can't buy Hype and I can't buy BNB, which are two
Right.
really big chains, right? How do you unify the world and getting so anybody anywhere can get what they want, you know?
Yeah, absolutely, absolutely. Jurisdictions are trying to, or regulators rather, are trying to regain jurisdiction over the geography that they control, and it's fair it's a fair ask, I guess, on their end. But you're right. I myself cannot buy hype the way I want it, um, and I don't have access necessarily to the markets that I want when I want to access them. So yeah, no, you're absolutely right that there's also aside from the coverage that I described for market makers, from a pure liquidity standpoint, there's also an access issue. I mean, Polymarket up until recently, for example, was not available to the US market. It is about to change, but up until recently, it was totally out of the question that, Polymarket could be accessed from the US, where we all know that the US is a major financial market, and also a number of the prediction markets on Polymarket were actually US related, right? So yeah, we see those access issues as well.
Yeah, that's one of them. And then the slippage, right? I think I see it less on Bitcoin, but slippage is more of an issue, kind of like on Ethereum, Solana, and some other chains, right? How do you improve that?
Yeah, so that's where we play a part. So obviously for the majors, I mean, obviously Bitcoin is by far the most traded asset. Of course, there are days where some other assets take over on certain exchanges and whatnot, but it's the most well known. It kind of like represents the original philosophy of crypto and the cypherpunks, right? It is limited, it is, trustless, pseudo-anonymous, and all the characteristics that we know and that we like about it, right? Now, again, we're in a somewhat of a strange cycle this time around, but historically, Bitcoin and its price action kind of like not dictated, but led, the price action of other assets, right? So you talked about Ethereum, Solana. These are what I would consider major cryptocurrencies, obviously. But yeah, no, this is where we come in play. Like foundations, for example, or token issuers are going to contract with market makers in order to provide liquidity on their markets, right? The market maker, especially in the way that we envision it at my firm, is to act as a liquidity provider almost regardless of market circumstances. It can seem counterintuitive because obviously market makers are sensitive to asymmetry of information, to adverse selection, to essentially market participants having information that we may not have, right? And that's normal, that's the efficient market hypothesis, or how, kind of like the information is priced in, right? So you might have what we call informed traders from a theoretical perspective that may take trades that are going to be select us in a negative way, right? So but aside from those considerations, we try to provide liquidity 24/7, year long, and we're contracted to do so, right? So under certain contract types with the market maker, you actually have KPIs that are embedded in those contracts, and the issuer has the freedom to decide to continue their engagement or not with a market maker if the KPIs in questions are not met. Those KPIs can be defined by the issuer, they can often be defined by the exchange in order to remain listed on a certain platform, right? You may have some spread requirements, some depth requirements, and so on. And in fact, we're pretty surprised that even on really big and largely traded markets, as a market maker, we still represent a significant portion of the order book, but not only the order book, but also the fill volume. So essentially, the portion of orders, limit orders that are actually filled by taker orders. And I was sitting with my trading team a couple of weeks ago, and we were going over the stats that we receive and the data that we receive from exchanges. And I was very surprised that still in 2025, after the industry has gone through a number of cycles and has matured to the extent that we know it, that we still do represent actually a very significant portion of the book and a very significant portion of the fill volume.
I want to get into the order book a little bit later, but you said a couple things that are important. I want to address first because I think you made the understatement of the year. You said we're in a strange cycle. Could say that again. It's not that this hasn't been a typical 4 year, regular cycle that Bitcoin's gone through in the past. So how
Mhm.
how is Bitcoin regulation, liquidity, like you said, and these digital asset trusts, paving the way? How are they paving the way for the next like the next step for adoption for global Bitcoin adoption?
Yeah, that's a good question. I mean, we've seen a number of developments, right? You mentioned regulation, and that's definitely one of them. You mentioned, treasury companies, that's another one. We've seen ETFs, right? And that was a major development. I guess it kind of like touches on regulation. And lastly, we've seen a very favorable political climate for cryptocurrencies in the US, right? And again, the US being a major financial market, right? So, all of these factors combined participate to the adoption to a certain degree. Now, obviously, crypto native players are going to say it is not, real adoption in the sense of, the cypherpunk philosophy or early crypto adopters. But nonetheless, it participates in the adoption. Let's take the example of ETFs, for example, right? You have, for a variety of reasons, certain types of investors that may not be able to access or custody or, frankly, spend time and effort in doing those things for Bitcoin, right? And so an ETF for Bitcoin or an ETF for major, coins and tokens is going to provide that access for, say, institutional players in XYZ jurisdictions. So they're going to be able to have that exposure, and that will be part of their portfolio. Maybe the narrative that we have all heard and that we hear more and more about Bitcoin, although it still is correlated with risky asset classes. The narrative of a reserve asset is going to prevail if such investors have access to Bitcoin in one way or another, whether it is spot Bitcoin or through a vehicle like an ETF or like an instrument like an ETF, right? If you take trusts, for example, for the same reason, some investors may not have access to Bitcoin spot. They might prefer to get exposure through strategy or other treasury companies, right? Now, and it might provide some form of leverage with big air quotes. You can access this leverage, of course, on other markets, right? Perps and whatnot. But they might not have access to perps for whatever reason. So I think that the combination of new instruments that replicate or that kind of like multiply, if you will, the fluctuations of Bitcoin, combined with favorable regulations, combined with favorable political decisions globally, is something that participates in the adoption of crypto, and that it will be part of more investors' portfolio. It will raise awareness about Bitcoin, and as a ricochet or as a ripple effect to the rest of the industry. So yeah, I do believe, although it is maybe not self-custodial in some instances, I do believe that it still participates in the adoption of Bitcoin ultimately.
Let's talk about that ripple effect, right? And you said
Yep.
ETFs. This
Yep.
week, supposedly, I say supposedly with big quotations around it,
Yep.
the SEC is supposedly going to approve the XRP and the Litecoin and some other ETFs. like
Mhm.
which they've been delaying forever, right? So how will those ETF approvals, if approved, affect Bitcoin and the other cryptos this week and this month headed into the next, I guess, bull cycle if we're not there already? How do you see
Yeah.
that impact?
Well, definitely for the underlying assets is going to have, an impact in terms of inflows and, for those who like the proponents of those underlying assets, hopefully net inflows. For the rest of the industry, I mean, the kind of like ETF approval has been a news that has been somewhat digested and that is somewhat priced in, especially for those that already have ETFs or that are part of a basket. Um, I believe that one of Grayscale's fund was approved to be traded as as an ETF essentially, and it included some of those assets, right? So, but definitely having an ETF of their own, clearly, dedicated for the underlying asset, is going to have an effect. Now, I've also seen, again, with the same caution that you expressed in your question. I've seen some news that the SEC may approve ETFs or may kind of like pave the way for an automatic approval uh, under certain conditions, right? With an asset that has been traded on futures market for more than 6 months and whatnot. Again, we'll see if that comes to fruition. But yeah, I mean, the markets have digested the ETF news, in my opinion. So yeah, it depends on who the issuer will be of the ETFs. It depends on what the underlying assets are going to be, and these will be the markets that will be impacted the most. And then, hopefully that stance from the SEC will pave the way for easier approval in the future. Again, ETFs are very much catered to institutional investors or investors that did not want, for one reason or another, be it self-custody or regulatory hurdles or whatnot, to have exposure to those assets on the spot markets, right? So yeah.
Got it. Well, let's hope for approvals. So,
Yeah.
um, you know, uh, even if there's not, I mean, you're a market maker, right? So I'm looking at like a couple of events that happened over the summer, like last month. That's a few weeks ago. Everybody, the market was booming, and then you had one Bitcoin, whale dump 60,000, sell 60,000 Bitcoin into the market, and the prices just
Yeah.
plummeted, right? How can we set up contingency risk plans or whatever measures where if somebody decides to dump that, the market's not totally impacted and that there's some stability despite one move. How do you still prevent that or safeguard against that?
Yeah, I mean, look, we've seen, I don't know if we're referring to the same example, probably not, because you said that the markets tanked. But, I've seen another one of those examples where there was this dormant wallet that essentially started moving, tens of thousands of Bitcoin. Uh, and, there were concerns, there were messages sent to this address or sent by that address, rather sent to this address, related to seizing the Bitcoins on said address. They were sent to multiple addresses. So, anyways, um, and like people were concerned that this would have like a significant impact on the price, which it didn't. I think that if such whales decide to liquidate on secondary markets, definitely there will be an impact, right? An immediate impact at least. And this is regardless of how much liquidity is provided at any given time. I mean, of course, more liquidity will absorb this selling pressure better, right? But also more buy side liquidity would also kind of like signal to some traders that the asset is undervalued. And so while an asset at, let's say, 100,000 may not be undervalued. Certainly, if the price was to drop significantly, if someone was to liquidate a massive position, And then, the price was to drop, say, 20% to 80,000, right? At that point, people may think, okay, well, now the asset is undervalued. So what may not be true at a certain price level will certainly be true at another one, right? Especially for no apparent reason other than potentially a liquidity need from a whale, or, taking profits, or whatever the reasons might be, or rotating to other assets, right? Anyways, what I'm trying to say is that short-term shocks to prices do not really have an impact. The other thing is, markets have matured enough that now OTC desks, or over-the-counter trading, can certainly absorb that pressure much, much better, right? Find counterparties almost instantly, right? And those counterparties could be market makers, they could be dark pools, they could be ATSs, and certainly, some of those counterparties are going to quote prices that are related to whatever execution price they can get on secondary markets, but definitely secondary markets in their aggregate, right? So in their global view rather than specific venues, right? So I think that, markets have matured greatly since, at least since I entered the industry a number of years ago, and a few cycles ago, where now, we have the capabilities not only to correct those short-term shocks relatively quickly, but also to absorb either buying pressure or selling pressure, through OTC desks that will not reflect on secondary markets to that extent.
Yeah. I'm thinking about it. Maybe it wasn't the market that tanked. Maybe it was just my portfolio. you know. But you brought up a good point. I've been thinking about something for a little while now. And there was this thing in the U.S. and Biden as president, and against there was the SEC called Choke Point 2.0. And their goal, I think everybody said, was, it failed because they didn't kill the crypto industry. But what I think it did, and you still have 70% retail as holders of Bitcoin and 30% institutions, even though the
Yep.
institution percentage is increasing. You
Hmm.
know, what if Choke Point 2.0 didn't fail? What if the goal is someday to have more institutional percentage than retail percentage, and then the institutions can get together and do a 51% or higher attack on Bitcoin and take it out? What if they set that up so that's possible? What is that realistic, or am I thinking too hard?
Look, I want to hope, first of all, that, and I believe, in general, that nations don't necessarily have that level of coordination. I mean, each nation has their own interest at stake, and, at heart. I mean, like, I was watching the UN interventions of a number of countries, and as much as they play the geopolitical game, and, it's at the end of the day, it's game theory as we know it, right? They all recognize that they have their own interests at heart, right? Which makes reasonable sense. So, I don't know if you're right that, the percentage of institutional kind of like holdings is going to exceed that of retail potentially someday. Um, Especially, if we see, government reserves denominated in Bitcoin or other assets. Um, that being said, I think that the money that will be engaged by said governments will be far too much to coordinate a 51% attack on the network that will take it down. The other thing is, I mean, like, yeah, it would essentially, like, as you said, kill it. And it would simply be counterproductive, in my opinion, for governments to do so. Now, the other thing, and plus we've seen, I mean, look, if we look at the directions that some TradFi firms are taking, right? They used to criticize, blockchain and or crypto at least. Now they're bringing on blockchain, where blockchain was precisely supposed to remove the middleman. They're bringing blockchain kind of like in an institutional way, in a centralized way, more importantly. And so you have private companies essentially creating their own infrastructure, kind of like, they're revamping their infrastructure to be potentially faster and more efficient and whatnot. Nonetheless, they're still centralized actors, right? I don't think that, to go back to your question, I don't think that, so the reason I was mentioning those institutions is to say that, TradFi is still um, trying to get a piece of the pie with, again, big air quotes. And I don't think that they have just given up entirely to the decentralization narrative. And I don't think that they will need kind of like the governments to help them retain, some form of monopoly, right? So, anyways, all of that to say that I think it would be counterproductive. It would be far too expensive for governments to do so. The other thing is that, the ideology that underlies Bitcoin and the creation of the network is still very much alive in the community. And I don't think that if Bitcoin was to face such an issue, there wouldn't be a solution that would be proposed by the community in the form of a new asset potentially, and one that wouldn't be able to be controlled in such way. Again, the cypherpunks have spent decades essentially theorizing and coming up with a system that would work for the problems that they had, in mind and they wanted to tackle. I have no doubt that, if such an extreme scenario was to unfold with a 51% attack by institutional players, that, some new assets would emerge that would, solve the potential issue in the future.
Yeah, yeah, that makes sense. So I don't think you can kill the cypherpunk movement. Definitely agree with you. Um,
Yeah.
so speaking of regulations, and this is kind of a boring area now because people were excited about it when it first started, but now it's like it might be an obstacle. I want to find out. MiCA initially seemed to
Mhm.
be a good step forward for European virtual asset service providers, right? But now might seem like an obstacle. Like, what do you think?
I mean, I agree that regulation is good for, I mean, um, we don't want people to lose their money to fraud or scams and whatnot. So in that sense, regulation is good for investors' protection. And then I also agree that, I think effective regulation provides clarity, provides certainty for businesses, but it also doesn't hinder innovation, right? And it doesn't prevent businesses from operating. And so I think striking the right balance is really hard to do. Now I understand that, Europe from a retail perspective and from an institutional perspective to a certain degree is not a region that you can avoid, right? I mean, like, it's a wealthy region in the world. It's not one that you can just simply ignore and pass on, right? So, for example, exchanges have a very reasonable case to get on board and to seek, CASP licenses. So you mentioned VASPs. VASP was a simple registration with the local regulator. So you would essentially make the regulator aware that you exist and that you operate in the jurisdiction. But it was somewhat of a light approach. And then at the beginning of the year or late last year, the MiCA regulation came into place and into effect. And now you have to have a full-on license, right? In fact, my company has applied and has received its CASP license from the AFM, the regulator in the Netherlands. And, we've had the opportunity, obviously, throughout the process, and, up until very recently, I was in Amsterdam last week, actually. We have the opportunity to have a dialogue with the regulator. Now, the hard part in Europe is that the regulator is governing their jurisdiction, but they have kind of like a body not above them, but that is essentially putting guidelines together called ESMA. And this body is essentially providing those guidelines to be implemented independently by the regulators in their jurisdictions. Now, one thing that Europe did well, in my opinion, was that they, among other things, obviously, but especially that one, is that if you seek a license in one jurisdiction in the EU and you receive that license, that CASP license, with what we call EU passporting, you're able to provide your services across the entire European Union, right? Now, one of, for example, the points of potential improvements that we brought to the attention of the regulator was to consider individual business cases, right? You can expect a regulator to regulate a number of exchanges, to and to have retail and potential accredited investors and whatnot in their mind when they're drafting the guidelines and the individual regulations. Nonetheless, they are going to exclude some business cases because they may not be aware that they exist simply, right? And so our role is to have that dialogue and to bring that to the attention of the regulator, which we did last week when I was there, in terms of explaining, our business model, which we did during the license application process, but certainly after, there was essentially, so ESMA, this kind of like body that provides guidelines to regulators in Europe, clarified during a Q&A, they clarified their position on a specific topic, which was sub-custody, as I mentioned in the beginning of our exchange. Essentially, what it means is that as a market maker, you receive working capital from an issuer, for example, and then you dispatch. So initially, it may be in cold storage. You then kind of like dispatch this working capital across a number of exchanges. Now, some of those exchanges may hold a CASP license, and that's perfectly fine. Some of those exchanges may not hold a CASP license. Now, under MiCA, you're supposed to hold 90% of client assets in cold storage, right? And again, that's to prevent a number of things for transparency and whatnot. So this rule is perfectly understandable. Now, ESMA said that when you deposit your assets, and it's not simply to settle a trade that has already taken place. When you deposit your assets on an exchange, it is considered for that exchange to have sub-custody. So in other words, this exchange should have the 90% rule in place as well. The only way to know that this exchange will have the 90% rule in place for sure is for that exchange to be regulated. And so what we explained to the regulator, as I was mentioning in the beginning, is that there is essentially a gap in coverage, right? Because as a market maker, you're going to deposit assets on an exchange, but you intend to use those assets to actively place limit orders, right? You have orders standing on the book waiting to be filled, right? And that's the point of a market maker, to place those maker orders that are then being filled by taker orders, right? So anyways, we explained that the point of depositing client assets onto exchanges was precisely for those assets to be deployed and to provide liquidity. And as a result, if we were not able to service certain exchanges because they were not regulated in the jurisdiction, that would provide a gap in coverage, especially throughout the secondary life cycle of a given asset, right? And so, this is a position that we're still detailing to the regulator and that we are advocating for. So yeah, there are good things about regulation for sure. And it really depends on how regulation is put in place. The other thing that we don't like is, if too much regulation and preventing innovation and preventing businesses to flourish is one thing, but the other extreme is no regulation whatsoever. This opens the door to fraud and scams and whatnot. And not only this, but it also opens the door to what we call regulatory arbitrage. So essentially, you may not want to conform to certain rules because it is not as practical, or maybe you have ill intent or whatever the reason might be, and so you can hop from jurisdiction to jurisdiction until those gaps kind of like close, right? So too much regulation, not great because it doesn't foster innovation, doesn't allow businesses to grow, and then too little regulation is also harmful. The hard thing is to strike the right balance.
Yeah, I can see that. I can see that. That makes actually pretty good sense to me. So, if I'm not looking for the regulators to provide stability, I am then looking for the market makers, right, to provide stability. So, how can market makers be the ones that provide stability for DeFi, for Bitcoin, and for healthier models for the business, for the industry going forward?
By doing what we try and aim to do well every single day, by providing liquidity. You mentioned stability. I think the regulator provides a different kind of stability. They provide kind of like certainty that the actor, the counterparty that you're dealing with, doesn't have ill intent, or is not going after, short-term gains or malpractices that pollute the rest of the markets. I mean, like we still see it at times, but it's hopefully starting to go down significantly, especially on those regulated platforms. But we still see wash trading, for example. We still see spoofing. We still see those kind of malpractices that pollute the industry and pollute the markets, right? So, regulators provide a different kind of stability. On our end, at the end of the day, even in terms of price stability, a market maker is not necessarily supposed to provide price stability. In fact, we're supposed to let the markets behave according to supply and demand, right? Now, of course, our goal is to mitigate um, the slippage and to mitigate, volatility to a certain degree. But yeah, no, we're here to essentially be the counterparty of choice, on secondary markets. So yeah, different kind of stability, I guess that the regulator is providing compared to market makers. On our end, is just doing our job well and not having, parasitic practices in place. There's one famous, that's very much getting into the details of it, but there is a contract with market makers that came into place last cycle, which is essentially this loan and call option model. If done improperly, it can definitely lead to, instead of providing value to the issuer, their investors, their community, essentially a transfer of value from those actors to the market maker's pocket if they are adopting this kind of like parasitic approach. Happy to dive deeper into that, but yeah, essentially how to provide stability, doing our job well, obviously having a regulator above or several looking at what we do, ensuring that we do it for the right reasons, is what is going to provide stability to the markets.
I do want to know about more about this parasitic approach.
Okay. So essentially, it's called the loan and call option model. So back in the days, issuers used to provide both sides of the inventory, right? They used to provide their token and stable coins. But then when the market started going down last cycle, issuers didn't want the downside exposure, the downside risk, right? If they were to provide, those balances to provide buy side liquidity. And so what happened is that they said, okay, well, we don't want the downside risk, but we're also going to potentially forfeit the upside exposure, right? We want the market maker to take the downside risk, and as a compensation, if you will, we're going to forfeit the upside. So it turned into another contract type where the issuer is providing a loan of their token, the one that they create, only and not stablecoins. And then associated with this loan is our call options. Um, it is a good model in that it is a transfer of risk and a transfer of reward as well to the market maker, right? But if used poorly, it can turn into something devastating. So the good approach, on the one hand, is to consider those call options, as I said, as compensation, right? Call options have an inherent value, right? Not only that, but as I said, in simplistic terms, the issuer is forfeiting on the portion of tokens that they loan. The upside, obviously, strike prices are determined in advance, or at least the conditions are determined in advance, and whatnot. Um, the way to do it poorly, unfortunately, and there are some actors out there, and there is no intention on my end to provide names or anything, but there are some, actors out there that adopt this parasitic approach, and it basically is the following. 95% of assets after 6 months, and this is a real statistic, after 6 months, end up below listing price. Now, initially, for most projects, of course, it has some variation project to project, but for most projects, the initial investors that invested prior to TGE, token generation event, and certainly prior to listing, the team for the project have tokens that are locked in vesting smart contracts typically. Now, the only player out there that has liquid tokens or that holds a significant part of the liquid tokens is the market maker. So the market maker, and usually when an asset lists, you see an initial price increase, what we call price discovery, essentially, when an asset comes to market, the community is and the traction that the project has received leads to some price appreciation, typically, not always, but typically. But the market maker has the vast majority of the float, has the vast majority of the liquid tokens at the time. So a market maker that doesn't have the right intentions could dampen the momentum that you see upon primary listing, right? Selling those tokens at a high point, essentially. And then the only thing that they have to do is that at the end of the loan term, they simply have to buy back the tokens on secondary markets at a depreciated price. Now, one, they have the majority of the float, so they can typically sell and dampen the momentum. Two, vesting contracts and unlocks are happening over time, which participates in increasing supply, and as a result, in this kind of like self-fulfilling prophecy, if you will. And what happens eventually is that if a market maker like this is involved on a given market, the issuer loses because of the poor price action. The early investors are losing because once their tokens unlock, they are unlocking at a depreciated price. And then the community loses because typically they're the ones participating in price discovery in the early listing stage, right? And so essentially everyone is losing to the benefit of the parasitic market maker in that instance, right? And not only this, but those market makers would consider the call option associated with the loan as an insurance policy. Why? Because I described in the beginning, I described the statistical approach where 95% of projects after 6 to 9 months end up below listing price. If that was not the case, the way for the market maker or the parasitic market maker um, to ensure that their losses are capped is to exercise those call options. And as a result, they treat those call options rather than treating them as compensation, like a good market maker would do. They're treating it as an insurance policy against their approach, right? So yeah, that's. I'm sorry if it got confusing, and I know we don't have visuals to illustrate this. We in fact wrote an article about this approach. And this was something that the regulator, in fact, asked us about last week in terms of malpractices that they should be aware of. Yeah, so it really depends on who the market maker is, how they do their job. Hopefully, they do it well. And the other thing is that those market makers are not providing real liquidity at the end of the day, right? So because as I said, they sell initially, they buy back at the end of the loan term. In between, not much happens. They're not going to diminish their profits by providing buy-side liquidity when the price drops. So, yeah.
Thank you very much for detailing this for me. I've seen it over and over again since
Mm-hmm.
2017, and I was like, I didn't know what to call it. There's a name for it, or I know who the people are. I'm not going to say names, but like now I know
Mm-hmm.
what their model is. So thank you.
Yeah.
You know, um, yeah, wow. So interesting. So I did have one more question, but it kind of goes into the area of parasitic approaches. But like people say,
Mm-hmm.
people say that the market all depends upon sentiment, right? So
Yeah.
I think from your perspective, you're providing liquidity. So I think why is liquidity and for market stability more important than hype?
Look, there have been in the literature, people have been trying to theorize, kind of like put in theory what a bubble is, right? And so there are certain conditions that are generally accepted for what a bubble really is and whatnot. We are, my personal belief is that this industry is indeed the future of finance, that some of those assets are truly true innovations, right? A Bitcoin, for example, is the purest form of property that humans can have, and that we've had in the history of humanity. Now, it happens in this industry that there are moments of FOMO, of hype, of you know bubbles that may arise, but we've seen bubbles in other financial markets, right? We think about the dot-com bubble. Well, subprimes were a different thing. The, debt crises, or sovereign debt crises. Potentially some people calling AI a bubble or an incoming bubble and whatnot. So yeah, we do see some bubbles arise. Now, calling the entire industry a bubble to me is not a thing by any means. Um, so, I don't know how important hype is. Certainly, it feels good to kind of like join the, the critical mass, I guess, and it feels good to be surrounded by people who share the same view. A lot of times, trades that are very profitable are contrarian in nature. But as humans, we don't necessarily want to deviate from our neighbors too much, right? And that's why, and it's in it's pure human nature, right? Much like when you have when you see a price rising, you probably want to buy more of that asset. If you see the price falling, you're concerned and you may want to cut your losses. This is human nature, right? And that's why, in fact, I got into algo trading, or the reason I guess I fell in love with it was because it strips away those emotions, right? Machines are not very smart, but they're certainly very good at computation, at repetitive tasks, and at not having emotions and not having any fatigue, right? And so I think that, you know, the genuine interest in the underlying technology, the genuine interest in what this industry has to offer, and the genuine interest in finance and what its future may like, is far better than than FOMO and than hype. Understanding that those are human emotions and they're perfectly uh, normal, But I think that, fundamental understanding, genuine conviction are more important than hype. So yeah, that's what I would say about it. I think we talked about adoption. We talked about, liquidity provision. We talked about regulation. Ultimately, I think that, people getting more and more informed about what the technology has to offer, what the industry has to offer, is going to lead to more adoption inevitably, right?
Yeah.
That's a good thing. And I think that ultimately, hype might be good for, quick trades, maybe, for fun, for, feeling kind of like surrounded by may potentially not necessarily like-minded people, but people who share the same opinion. But these are short-term feel goods, right? They're not necessarily dictating what, what the fundamentals of the industry are, certainly.
Well, that's been. I agree with you. I agree with everything you said. So I want. This has been great. So I want to thank you very much for your time today. This has been an amazing conversation. I enjoyed speaking with you. And I have one last question. It's probably the easiest one I asked you. It's how can people find more information about you and about Asheron Trading?
Yeah, well, first of all, thank you so much, Jamil, for having me on. Appreciate the time that you gave me. Yeah, people can just go to ashrontrading.com, and they will have, information about what we do. We have a blog. If you go at the very bottom of the website, you will see a link to our blog where we publish hopefully quality content. So again, this is aiming at providing information about what a market maker does, how they do what they do, providing transparency. We're very big about providing transparency to everyone, frankly, to our clients, to our prospects, but certainly to the rest of the industry, to the regulators. So yeah, the website, I guess, is the best way to learn more.
Awesome. Thank you very much for your time today.
Thanks, Jamil.